There's a good chance that we are going to see a fundamental shift in the market, a shift that we haven't seen for more than a year. What I'm talking about is how much money is flowing into crypto. The nice thing about blockchain technology is that it's 100% transparent. We can see who's buying things, who's selling things, how many stablecoins get created, how many stablecoins get redeemed for fiat. We can have a look at this over time for all blockchains, and that data is very valuable. This is the stablecoin market cap over time. And there are times when money is flowing into crypto. So that is when the stablecoin market cap goes up. Then there are times where not much happens. And then the crypto market as a whole tends to contract. This is when the stablecoin market cap is going down. Since October of 2023, we are in expansion mode again. We've never seen that many stablecoins ever. Now, how do stablecoins get created? How do they get destroyed? It has nothing to do with trading. If you've got Tether or USDC or DAI in your account and you swap this into an altcoin, nothing happens with the overall supply of the stablecoins. Because during the swapping process, the stablecoins simply just get moved, say from your wallet to a liquidity pool. The way stablecoins come into existence is by the issuers creating them, minting them. Now, how does Tether create new stablecoins? They get fiat money, right? They get US dollars. They then park this in an account somewhere, and then they issue the corresponding USDT tokens on the chain. So when you're sending your hard-earned fiat currency to a centralized exchange, and you then want to swap this into something, the centralized exchange might send that fiat to a stablecoin issuer that then takes custody of the tokens. The same happens the other way around, right? When you're cashing out of crypto, when you want to get your fiat money out of the centralized exchange, then the Maxis and Qcoins and Binances of this world will send over the stablecoins to the issuer. The issuer then sends back the fiat money. And so that's then how this chart goes up and down and up, and currently people are sending their hard-earned fiat to the stablecoin issuers. Now, the nice thing about this chart is that it doesn't have too much volatility, right? We can see the current trend relatively clearly. Last time when we turned from bull market to bear market, we had a phase of nothingness that lasted for roughly 3 months. When we turned from the bear to the bull market, we also barely changed in the stablecoin market cap again for roughly 3 months. Currently, we are going sideways again, but not yet for 3 months, only for 2 weeks. Roughly. There is a difference though from this current peak to the peak that we had in 2022. The stablecoin market cap is at all-time highs, but the total value locked in decentralized finance is not at all-time highs. So when we look at all of the DeFi protocols across all chains, that peaked at 180 million in November of 2021. It then had a bit of a correction, recovered again in April of 2022. And April 2022 was also pretty much the end of the bull run. Afterwards, we had the implosion of Terra Luna, of the Anchor protocol. Now, I believe that decentralized finance can be the Achilles heel for crypto, because there might be some hidden weak spots, right? When we've got a DeFi protocol that promises 20% per annum and that in the end doesn't grow by 20% every single year, then at some point something has to break somewhere. And that is what happened with Anchor and Terra Luna at that point. Anchor was called the better savings account. People use crypto as an alternative to just holding cash in the bank, but then that narrative was ended very quickly and people withdrew from crypto. The fact that DeFi hasn't recovered as quickly as the stablecoin market cap, I believe, is a good sign. It tells us that overall risk might not be as high compared to 2022. There is though one shift that I believe is problematic, and that shift has to do with Ethereum. Ethereum being the largest of all the blockchains in terms of how much capital is locked up. Because Ethereum moved from proof of work with all the Ethereum mining to proof of stake. And since that move, Ethereum underperformed Bitcoin. We all know about this. But there's now one more shift for Ethereum that might even turn the price action more bearish. Here is something I don't see enough people talk about. This is how much Ethereum is currently locked up, how much Ethereum is staked, And there was the possibility to stake Ethereum even before the switch from proof of work to proof of stake. The staking program started in November of 2020. The merge or the move from proof of work to proof of stake happened in September of 2022 though. So initially the launch of the staking program really helped Ethereum. Ethereum outperformed Bitcoin by 172% up until the merge. Since that transition from proof of work to proof of stake, Ethereum underperformed by roughly 60%. And the problem is that Ethereum might underperform even more, bringing down a lot of altcoins with it. Because again, let's have a look at this chart. We had very constant growth in the number of Ethereum that got staked, but that growth has halted. In the last 4 to 5 months, we haven't seen any more net growth in staking. So we're now at 33.9 million Ethereum stake, and at the beginning of August we had been at a very similar level. And Ethereum underperformed Bitcoin since then by 20%. Since the launch of the staking program, Ethereum outperformed Bitcoin by 13%. But shouldn't we expect much more outperformance given that all of that Ethereum has been moved out of the liquid supply? One might expect that with the withdrawal of all of that liquid supply, Ethereum should be doing very well. The total supply of Ethereum is 120 million, and so there's 28% of the entire supply that got removed from circulation. Yet Ethereum barely moved. Now, why is that a problem? It's a problem because the Ethereum price is very much linked to a lot of altcoins as well. Ethereum's price has an overall impact on all of crypto. Just have a look at how Ethereum's tokens performed in the last 24 hours. Pretty much every single token went down, while the same cannot be said for the tokens on Solana or on Base. Many altcoins are priced in Ethereum, not in US dollars. The liquidity pools are against wrapped Ethereum. In other words, when the Ethereum US dollar price goes down by 10 or 20%, then automatically those kind of altcoins also go down by 10 or 20% in US dollars. For example here, right? This is the layer 2 on top of Ethereum. This is Arbitrum. Most trending tokens are still trading against wrapped Ethereum. So that's this light gray. There are tokens that are priced in USDC, but most tokens are priced in wrapped Ethereum. The same is true on Optimism, another layer 2 on top of Ethereum. Again, when ETH is going down by 10%, then all of those tokens also go down by 10%. And I believe Ethereum has way more room to go down by more than just 10%. Again, 28% of the entire Ethereum supply is currently locked up. And if this chart here turns around, if we actually see net withdrawals from the staking program, if people actually lose hope for Ethereum, then this will impact the entire ecosystem quite a lot. Relatively speaking, in terms of total value locked, it doesn't really look like Ethereum is losing ground. So currently 56% of all of total value locked across all DeFi is Ethereum. And we had been at a similar level in January of 2022. Yet the Ethereum relative to Bitcoin price went down that much. I think that's because of two effects. First of all, when Ethereum goes down, then of course a lot of other altcoins go down as well. But secondly, a lot of the stablecoin supply is still on Ethereum. And stablecoins don't change their value just because people sell ETH, right? Stablecoins are one-to-one backed with whatever is held in custody. Have a look at the stablecoin market cap. 54% is held on Ethereum. So this is where Tether and USDC, etc. issue their tokens. There's also 29% on Tron. I'm not sure how legitimate those stablecoins are though. We had another video on Tron on this channel where we looked at the source of the wrapped Bitcoin on Tron. There is no corresponding deposit on any wallet of real Bitcoin on the real blockchain where we could say, okay, this is the proof of reserves on Bitcoin and that corresponds to whatever is issued on Tron. There's nothing like this for Tron for Bitcoin. I am not sure if there's anything like this for the stablecoins on Tron either. So I've got a big question mark about the legitimacy of the stablecoins on Tron, and then we can actually see how much Ethereum is dominating the stablecoin market. If you take Tron out of the equation, probably 3/4 or more than that of all of the stablecoin money is on ETH. And that then explains why the total value locked isn't really changing that much relative to other blockchains, even though Ethereum, relatively speaking, is losing ground. If Ethereum really was to implode from here because all the people unstake, and if the stablecoin market cap now stops growing for whatever reason, if the last 2 weeks are an indication of what's going to happen for the next 2.5 months, then I think the most likely scenario is that Bitcoin will also suffer from this. And so because of this, I believe it's important to have a reasonable allocation to Bitcoin and to crypto as a whole. We are currently not dirt cheap. This is Bitcoin with its average cost basis, with the realized price. How much did the market on average pay for a Bitcoin? And there are times when the current price is below the realized price. So that is when the market in aggregate is in losses. And those are the times when it makes sense to buy. Those are the kinds of times where nobody watches crypto YouTube. Those are the kinds of times where the real winners get above average exposure. You do not want to have above average exposure during times like now. The realized price is at 40,500. The current price is 2.5x above that. It is going up, so that's good, right? A growing realized price is good. But I think there is a good chance, probably higher than 50%, that the current price will fall below the realized price in 2025. Just have a look at how often this happened in the past. We had this in 2011. We had this then again 4 years later in 2015. We had this then again another 3 years later in 2018. Then one more time 2 years later in 2020. Then again 2 years later in 2022. And since we haven't fallen again 2 years later, so in 2024 below the realized price, it is somewhat overdue to now fall in 2025 below the realized price. I'm not saying that this kind of rhythm has to continue, but it's still good to be aware of this, right? We get those dirt cheap prices every 3 years or so. And so seeing Bitcoin again at say 50K or 60K, I think is possible. It's all about having some kind of a system, right? There are all kinds of mathematical approaches out there. They all say similar things at similar points in time, but it's important to be below average exposure whenever those systems say we are very expensive, and to be above average exposed whenever we are dirt cheap. So here's, for example, the MVRV score, the market value to realized value z-score. So this looks at how much are we currently in profit relative to the current volatility. And of course, we are in the green whenever the current price is below the realized price. That's when we should actually buy. And we aren't yet hyper red, but does it make sense to be exposed to the same degree as if we were below the realized price? Probably not, right? It makes sense to have less exposure to crypto compared to November of 2022. You want to be maximum exposed during times like this. You want to be minimally exposed during those peaks. And you want to have an average exposure whenever we are somewhere in between. There are a lot of different approaches, right? And all of them say similar things at similar times. It's simply important to ride the waves somewhat, I believe. Of course, you can simply just buy and hold Bitcoin forever, but then don't complain when you go down by 80% every now and then, and you don't really take advantage of those lower prices because you don't hold anything else besides Bitcoin. I believe it's better to have something else than Bitcoin and crypto at those high levels, and to have mainly Bitcoin and crypto at those low levels. It's simply what worked for me. It might not work for you. For you, it might make more sense to simply just buy and hold and forget about everything. But I think one of the advantages of Bitcoin and crypto in general actually is the volatility. If we've got an asset that survives over the long term, but at the same time that fluctuates a lot, then why not take advantage of low prices and then sell whenever we are heated? Now, here's the thing. There are plenty of topics within crypto that aren't very sexy, but that are, I believe, very vital to make money long term. For example, concepts like correlation. What we see over here are correlation coefficients. Did you know, for example, that most altcoins tend to be more correlated with Ethereum than with Bitcoin? In other words, it's not when Bitcoin goes up that the altcoins go up as well. It's rather when Ethereum goes up, then the altcoins go up as well. Or did you know that the correlation coefficient of the S&P 500 to Ethereum, and thus the altcoin market, is actually quite volatile? In other words, it does make sense to also own stocks, not just Ethereum, not just crypto. The common narrative is that when traditional markets go down, that crypto tends to go down as well, right? That crypto is simply just a levered bet on, say, technology stocks. That's not the case. The correlation coefficient is relatively close to zero. Or do you know the long-term expected returns of various asset classes, of say gold, of say the S&P 500, of Bitcoin, Bitcoin, of altcoins. When we don't just own crypto, but we also own property, for example, and we've got that portfolio, what kind of returns do we need in order to beat monetary debasement, but also in order to at some point to get financially free? How much money do we need to have enough passive income to not having to work anymore? What are expected long-term returns, and how much should we actually allocate towards crypto and towards property, towards stocks, gold, bond, etc.? What actually makes sense? When there are tens of thousands, hundreds of thousands, maybe even millions of dollars on the line, not having this properly nailed down is a huge problem. And when the market isn't that great anymore and the upside for Bitcoin could be somewhat limited, how can we still make money? How can we make money from charts like this? What we see over here is Balancer relative to Ethereum. We can make money by shorting this. Balancer has very bad tokenomics, the supply increases over time, and so it tends to do worse than Bitcoin and Ethereum over the long term. And we can make money from that, again, from the relative valuations, not just from US dollar valuations. When we look at how quickly is the monetary base expanding, and we put this into relationship to how quickly are salaries increasing, we actually see that pretty much everybody is falling behind over time. And this is not just true for the poor people, this is even true for the top 5% of earners. By the way, if you earn $500,000 per year, then you are in the top 5%. But yeah, data like this is useful. And those are not necessarily the sexy topics that work well on YouTube, right? On YouTube, it's the 100x altcoin gems that get all the clicks. But when you talk about diversification and correlation, etc., people just fall asleep. But it's the long-term planning, the long-term proper allocation towards different asset classes that actually make the difference. And so have a look at all of this. Those are tutorial videos of the premium membership of this channel. It's down below, thebitcointrader.com. There's more than 100 tutorial videos in total. What are my favorite crypto macro indicators? How do interest rates impact different asset classes? We've just seen how the market got spooked because the Federal Reserve might get more hawkish. Or how do we adjust our returns for risk mathematically, right? Everybody can get more returns by increasing the risk massively, but the idea is we want to get the best returns for the risk. And so there are ways to calculate this using alpha and beta. Those are all very complex topics, but I strongly believe that it's the skilled people, the people that have most knowledge, that tend to make most money over time. Now, besides all of those tutorial videos, there are also various chats in premium where I try to be active as well. So in case you've got any questions, just tag me in a message in those premium chats and I try to reply. The membership is currently $165 US per month. This is not for people that only have a net worth of $1,000, right? This is for people that actually have to manage wealth in the tens of thousands, preferably even hundreds of thousands of dollars. There is a 1-week money back guarantee as well. So in case you don't like premium, just message me within the first week and I refund you 100%. There's really zero risk for you. Now, if it's your first time here, feel free to subscribe. I publish videos regularly. A like would be very much appreciated as well. It helps the channel grow. See you in the next video or see you in premium. Cheers.